The crypto crash continues with Bitcoin getting down under $33,000 in the last 24 hours, although we are currently seeing a bit of a relief for the markets. In today's video, I want to talk with you about what you need to know this week for the markets. We have a big meeting coming up for the Fed, which is what everyone is going to be talking about. So that's what we're going to be talking about in today's video. My name is Lark. Every day I make videos talking about cryptocurrency investing. So if that's a topic you enjoy learning about, maybe you just want to stay up to date with, then definitely tap on that thumbs up button just to let me and YouTube know that you do like this kind of content. By the way, every single week my team and I produce Wealth Mastery. This is a cryptocurrency investor report designed to help keep you ahead of the curve in this fast-moving market. We have DeFi tutorials, altcoin reports, technical analysis, tips, tricks, portfolio updates, airdrops, token sales, NFTs, and much, much more. You can sign up for free using the link down below or go premium for less than $10 a week. Now, let's go ahead and get into this topic. So I posted this chart earlier, but we may get a decent relief rally for the cryptocurrency market after, of course, that big sell-off here. Just keep in mind that we do still have a long way to go before we can say the bulls are back in charge of the price action. Look how far away we are currently from the 200-day simple moving average. Pretty gosh darn far away. It's all the way up at $48,000. That's really the bull bear line in the market. When we're trending above the 200-day moving average, that is a bullish time in the market. Trading underneath that, a bearish time in the market, as we are obviously experiencing right now. We would have hoped for a very short bounce underneath, then come back up, much like we saw in September. We see the correction that we are currently facing is much deeper, much more extended, much more like what we saw back mid-2021. So that is the line to beat. Until we cross back over this, we can't really say that there's a definitive direction being reestablished in the market. Relief rallies will probably see some sell-offs for coins, making it harder for us to get up and over that line. Though the Bitcoin monthly RSI, currently at 52, did reach 50 earlier today. Now, historically, readings this low have marked market bottoms, especially readings under 50, which we have not actually got yet. So we can still go lower. So you can see back here in 2015, we had a reading of around 40 something. Same at the end of 2018 when we had the big just 50% down in a couple days during the Bitcoin cash wars back in the day. This is the COVID sell-off right here. And this is where we are currently, right here. So we can go lower. We did tap 50 today. We could still go down into the 40s for a monthly close, a few days still to go before we see the monthly candle actually closing, which will determine where we finish up for the RSI for the month. Something to keep an eye out for. However, readings this low have historically been periods of opportunity, just so you realize that. We're also seeing a lot of fear in the markets, as you can imagine, obviously. This guy here, macro charts, NASDAQ investor sentiment is worse now than it was in March 2020. Have a look at this here. We're actually down here, right down there. This is the COVID crash right here. We are currently lower than the COVID crash in terms of investor sentiment for the market. So that is pretty crazy. Bearishness has fallen to such an extreme that it supports a significant stock market rally. Interesting. Very, very interesting. Bitcoin fear and greed, of course, also down very, very low, currently sitting at 12. We've had an extended period of extreme fear in the market. There can always be more fear. The markets can always go lower. There can always be more lower readings on the RSI and all this kind of stuff. However, historically, these kind of lows of, technical indicators, these kinds of lows of market sentiment tend to be, again, periods of opportunity in the market, although we could always go lower. And I say this because there's still a lot of uncertainty in the markets, a lot of tension weighing heavy on global markets. For example, we have the Russia-Ukraine tensions adding more fear into the markets. People are now afraid that there's going to be a new war happening on European soil, which would obviously be a negative thing for everybody involved. Now, we can hope that this all just ends up being nothing more than a big old fat Johnson measuring contest. Who's got the biggest one? Who can wag it around the most? Hopefully, of course, cooler heads do prevail and diplomacy will prevail. We also see this weighing on the crypto industry. Crypto industry awaits Biden reported crypto executive order, which will make its stance on cryptocurrency more clear, except we have no idea what it's going to say. So again, more market uncertainty. This is expected to come out in the next week or two. Fingers crossed that it's something positive and they don't take some dinosaur-like approach to the cryptocurrency industry. I think we had a lot of generally positive stuff coming out of the US recently, but then you do have Janet Yellen in the president's ear, and she's relatively anti-crypto, unfortunately. So we'll have to see what that looks like. Again, it's uncertainty, right? More uncertainty in the market. Will there be a war? Will there be negative regulations coming out of the USA? And just what the heck is happening over at the freaking Fed? Bitcoin surges $3,000 off the lows as rate hike odds tumble. So the odds of seeing rate hikes, the odds of that have gone down. So it's really all about the Fed. That's what everyone is talking about. So currently you have some of the big investment banks, the JP Morgans, Goldman Sachs, these guys talking, saying, hey, we might see 5 or 6 or 7 interest rate hikes. Be really, really scared. That is, of course, all just rampant speculation from these big financial players who are probably shorting the market, buying up assets on the cheap. You guys know how the big money game works. Now, what we do need the Fed to do, as this article says, they need to lay out the schedule and stop the speculation. The speculation that there's going to be 5, 6, 7 rate hikes, that we don't have a schedule, that there is still all of this uncertainty. Remember, markets don't like uncertainty, and that's exactly what we have right now. Uncertainty around the world's most important central bank and their policies moving forward, which will affect global markets, U.S. equity markets, basically everything. So as they say here, hopefully we see the Fed announcing a first hike in March rather than allowing for the speculation to continue. To define a target for year-end rates, will it be 1% higher, more or less? Where is that going to go? Is there really a reason for the Fed to not know right now what the plan is going to be? So they need to lay out also the tapering schedule, clarify the balance sheet reduction plan. That's going to be a big one because they're going to, that could be very, very consequential to the market as well. And explain how this new schedule will attempt to fix the soaring inflation rates instead of letting the speculation continue to run. I'm sure the Federal Reserve is, of course, doing this semi on purpose, letting the big banks short the markets and all that stuff. But regardless, once we do get some kind of certainty what the Fed's going to be doing, and if it is better than feared, could be a good thing for the markets. Once we know, okay, this is definitely what's happening. This is when the rate hikes are coming. There's going to be 3 rate hikes, not 7 rate hikes like some of the big banks are scaremongering for. Then we'll have a lot more clarity about how we could see the markets moving forward. Now, a lot of people are saying once the rate hikes start, that's the end of the market. But the data does not support that. So analysts at Deutsche Bank have identified 13 separate hiking cycles since 1955, which lasted an average of under 2 years. According to their research, which examined the average price performance of the S&P 500 on a daily basis, there tends to be solid growth in the first year of the hiking cycle, with an average return of 7.7% after 365 days. So that means once we get the certainty, once the rate hikes start, we could still see the markets finishing the year in a bullish way. However, we could still see a couple months of not bullish price action happening. But once the effects of all the things that the Federal Reserve is doing start to come into play, none of this stuff happens overnight instantaneously, right? It takes a while for these things to actually have their downstream effects. So that's why it takes a bit of time afterwards for this to happen. So we could still, within that first year, which hopefully if they announce the first interest rate hike for March, is going to be this year, leading into potentially early 2023, where we could still see the markets moving higher during that time before this really starts to weigh, the actual effect of it starts to weigh on the market and drag them down for a bear market in 2023 for all markets. Mark Yusko, though, coming out and saying a bull market is one that goes up most days but goes down big on bad news or perceived bad news. A bear market is one that goes down most days but goes up big on good news or perceived good news. Answer honestly, where are we now? This is in response to this guy, Dave Collum, who said you may think a 5% rally off the day's low is bullish. You could be sorely disappointed. Those are common at the start of big bear markets. He says at one point, the top 13 rallies in the Nasdaq's history occurred in the 2000-2002 window. Interesting. Food for thought, right? Food for thought. Now, all that being said, all the fears around the Fed and stuff like that, I want to finish today's video on this point. Most people forget this last bull run started because global macro legends like Paul Tudor Jones and other top funds crowned Bitcoin as Gold 2.0, an emerging store of value and an inflation hedge. The current events only validate their original fears. The thesis is just starting to unfold, which is really just, it sums up a lot of what I feel about Bitcoin and crypto. You see what's going on at the Fed, and it's weighing heavy on the equity markets, which because of everybody running to the exits and dropping risky assets, which they see crypto to be, the reality is that the smart money guys understand the asset class and everything that they fear is playing out. Central banks have no idea how to control things. It's a mess. And we see crypto adoption soaring. We see millions of people coming into the markets every single month. NFT adoption soaring like crazy. Gaming, DeFi, stablecoin transfers, buying Bitcoin as a gold-like asset within your portfolio. All of this stuff is only going to continue happening. Bear, bull, up, down, long-term picture, we are going to be fine. But, before we are fine, long-term, there could be some turbulence in between. So make sure you're fastened your seatbelts. Anyway, thank you for watching today's video, and peace out till next time.